Welcome back to the Global Ledger. I'm Justin. When people talk about the business cycle, they usually mean one of two things. They're talking about expansions and recessions, growth and contraction, booms and busts. And the explanation usually follows the same script. Demand rises, demand falls, policy responds, the economy adjusts. But that story misses something fundamental. Because before production slows, before employment weakens, before earnings fall, something else usually breaks. And that's funding. And that's first. So today's episode asks a simple but powerful question. What if the business cycle is really a funding cycle? Let's get into it. Why is output a lagging indicator? Okay, we're talking GDP, employment, and earnings are all end results. They respond after conditions tighten. They confirm what has already happened in markets. Funding, on the other hand, moves first. When funding is abundant, credit expands, leverage rises, risk-taking increases, balance sheets grow. When funding tightens, positions are reduced, credit creation slows, investment pulls back, right? Activity contracts. The real cycle begins in financial balance sheets, not the factories. So what do we mean by funding? Funding is not just borrowing. It's the ability to continuously roll obligations. Repo, commercial paper, bank deposits, FX swaps, margin funding. Most modern finance does not fund itself once. It funds itself every day. As long as funding rolls, the system looks stable. When funding stops rolling, the system contracts, and fast. This is why cycles feel sudden. So let's talk about the expansion phase. Okay, this is when funding is easy. Okay, so during expansions, volatility is low, collateral is trusted, margins are thin, spreads compress, funding becomes cheap and plentiful. Balance sheets expand not because optimism rises, but because constraints loosen. Risk-taking looks rational. Okay, leverage feels safe. Liquidity feels permanent. This is not excess. It is structure doing what it is designed to do. Let's talk about the turning point. Okay, this is when funding tightens. Cycles don't turn because sentiment changes. They turn because constraints bind. This can happen due to rising rates, volatility spikes, regulatory thresholds, balance sheet limits, and collateral revaluation. Once funding tightens, leverage must shrink. Liquidity evaporates. Asset prices adjust. So importantly, though, the real economy has not yet changed, but the financial conditions that support it already have. Okay? So this is why, let's frame this way. Okay? Let's ask the question. Why do recessions feel like sudden events? To the real economy, funding contractions arrive abruptly. Okay, companies suddenly face tighter credit conditions, higher refinancing costs, and lower asset values. Okay, consumers, on the other hand, face reduced credit availability, falling wealth, and rising uncertainty. Okay, so by the time layoffs begin, the funding cycle is already turned. Recessions don't start in GDP, they start in balance sheets. Okay, so when policymakers intervene, they often say they are stimulating demand, supporting growth, easing conditions. Okay, but operationally, what they are doing is restoring funding, stabilizing collateral, and reopening balance sheet channels. Policy effectiveness depends not on intention, but on whether it restarts the funding cycle. If funding flows again, activity flows. If it doesn't, stimulus fails. So why are cycles seeming to get shorter and sharper? Modern funding cycles are faster, more synchronized, more global. Why? Because funding today is centralized, it's automated, and it's globally interconnected. Okay, this makes expansion smoother, but contractions sharper. The cycle compresses. So once you view the business cycle as a funding cycle, markets can make more sense. Okay, policy reactions become a little bit more clear. Crises stop feeling mysterious. Okay, you stop asking, why did the economy suddenly slow? And start asking, where did the funding break? Okay, that question leads you directly to the real fault line. Now that we've framed the business cycle as a funding cycle, there's only one thing left to do, and that is to prove it. Okay, so in the next episode, episode 96, we'll walk through a real crisis from start to finish and trace the funding breakdown step by step, okay? And we're going to do this not as a historical lesson or any kind of narrative, but as a full system case study, okay? Not as deep as the deep cuts that are coming on the channel soon, which will be a lot longer, but deep enough to where you'll want to continue to learn more about the system and those parts that we talk about. I'm going to do my best to break those parts down. And so episode 96, we're going to go through the anatomy of a modern financial crisis. We're not going to hit 2008, but we're going to talk about the 2020 global dollar dash, really the global dash for liquidity. And that was in 2020, March. So that's where everything we've built so far kind of comes together. Okay, so that's next. So thank you for listening to episode 95 of The Global Ledger. I'm Justin, and thank you for being here.